Good afternoon from Savannah, Georgia, here with Dr. Walter Kemmsies on the Northpoint of View. Walter, good afternoon.
Good afternoon, Mark.
Hey man, we're starting the year off. We've talked a little bit about the watchword for the year, which at this point seems to be uncertainty. We've touched on labor a little bit. We've, the conflicts and constraints around housing and the growth of the Southeast, but something of maybe a contrarian concept that you and I were talking about on the break, and it's, to me, it's fascinating because it's a reset. It's one of those paradigm shift. It's the new normal, if you will.
Yeah.
And it's margin compression.
Exactly.
And love to hear you sort of outline that. And I've got some specific questions about that, how we sort of adjust our thinking to that. But give us the big picture.
Yeah. So in the other podcast, we talked about labor and that the labor force or the workforce is barely going to grow.
Right.
So the balance of power. We also talked about the number of strikes, the largest in decades. And what that's telling you is the balance of power is shifting away from corporations and to labor. It's shifting away from Wall Street and to labor. We're seeing companies say that even if there's a recession, we're not going to fire our folks, but some did anyways, but they were white-collar workers, not the blue-collar workers.
Right.
So, there's clearly a shift in the balance of power.
And some of that, was born out in the pandemic about where people are going to work.
Exactly.
i.e., I'm not going to come to the office.
Right. Yeah.
Right.
So I am definitely not going to come to the office. So under these circumstances, wage growth is not likely to be the 2% that it was running at during the almost depression that the Fed caused in the first half of the 2010s, right? Bernanke screwed up big, and then he got a Nobel Prize for rescuing the economy from the mess that he himself did.
Yeah.
Talk about irony.
That's an interesting cycle there.
I don't get this world. But anyways, we are probably going to see higher wage growth simply because there's a shortage of labor supply.
Right.
So what does this do to company profits? It reduces them. The other thing is, it's nice to shift to electric vehicles if it works and it improves the environment. But the problem we have right now is what's happening is the oil industry making a lot of money right now, especially because Europe has pulled away from Russia. But I think we end up with permanently higher energy prices than we had before.
Right.
So that impacts things.
It's almost baked into the process.
Right. So I think if I did a study when I was a stock market strategist of what was the long-term sustainable EBITDA profit margin. And that's the earnings before interest, tax, depreciation, and amortization, right? So that's a kind of like a headline profit measure. And globally, I found that 28% was sustainable. It was high enough for the company to reinvest and do well, but not so high that it attracted competition. And the last time I checked, profit margins for U.S. companies were in the 20% range. I would say take 5 to 10% off of that. I think it's going to be very tough in many industries. Not all of them, but in many industries, it's going to be very tough.
And as you look at that, from let's say a stock market perspective, mm-hmm. and you and I've talked about a little bit about how, maybe the overall market, if you look at PE ratios, et cetera, maybe a little bit overbought.
Yeah, we were looking at that long-term chart for the S&P 500 that starts something in the 1930s or so, and the last few years look extremely bubbly.
We're above the trend line. Let's say that, right?
Exactly. So I have not heard people on Wall Street. I haven't seen any research on Wall Street where they look at these issues, particularly the labor side, and then look at what would be a sustainable profit margin. You know, Japan's been struggling with this for decades, but I just don't think you can expect to make the same percentage of your revenue like you did before.
And then, you know, in terms of the labor, you know, as labor does sort of, if you will, gain the upper hand, then, you know, this could be the beginning of sort of a long-term reset.
Yeah.
Right? I mean, you look at the you know, who's calling the shots and you know, what's acceptable for the bottom line, labor taking a bigger piece of that. Mm-hmm. There's a tipping point in all that where, you know, once these things are sort of embedded, it takes a while for them to be reset again.
Right. And the problem is I don't think people see it's coming. You know, across the country, you already have a number of cities and counties that will pay money, will pay you to go move there. And so, you know, my son's best friend from college was living in Brooklyn, New York, and he studied to be an artist. And being an artist doesn't pay very well. And Tulsa, Oklahoma was paying good money for you to come. They paid for the move. They get you affordable housing, and he's getting free college tuition. That's, you know, draw the population from another city. And
weather this time of year in Tulsa is probably okay, right?
Yeah, exactly. But the problem is we're just not making enough people to supply the labor needs of the country. And that's the fundamental thing. And I told you on the other podcast, I had to call my old dissertation advisor, Dr. Tom Savian, and kind of talk it through with him. By the way, he worked on the Social Security reset in the early 80s when the Social Security system was going to go bankrupt,
right,
in Medicare. So he was one of the economists on that. And they had struggled because what had happened to the Social Security system is people wouldn't die. You know, they were supposed to retire at 65, die at 70, we're good. But they were retiring at 65 and they refused to die. Like,
we got to do something about that, right?
Exactly. Those baby boomers, you know, hell no, we won't go.
Well, you know, the whole idea, you know, of margin compression is interesting, and how it, you know, could feed into, you know, overall, you know, long-term profitability projections, what the stock market does, et cetera. So I guess when we see the first article about that in the Wall Street Journal 6 or 8 months from now, we can say, well, you heard it here first on the Northpoint of View, right?
Exactly.
Dr. Walter Kemmsies, always great to be with you, man.
Yeah, same here.
All right,
Take
thanks.
care.
Have a good afternoon.